Welcome to The Explainer. Have you ever wondered how a huge airline accounts for its fleet of jets? Or how a tech company puts a value on its massive data centers? Well, turns out it all boils down to one set of rules that governs a company's physical world, all its stuff. Today, we're digging into International Accounting Standard 16, and we're going to uncover the story of a company's most important assets.
So here's our game plan. We are going to follow the entire life of an asset, from the moment it shows up on the books, through all its years of work, right up to the day it's retired. And definitely stick around, because at the end, we're going to tie all these rules together and see what they really tell us about a company's strategy and its financial health.
All right, let's kick things off with a little puzzle. What on earth could a high-tech, multi-million-dollar jet engine have in common with a quiet, peaceful vineyard? It sounds kind of random, I know, but the answer gets right to the heart of everything we're talking about today. So just keep that question in mind for a minute.
Okay, first things first, let's get the official language down. You see, accountants have a specific name for all this physical stuff. They call it property, plant, and equipment. But you're almost always just going to hear it called by its initials, PP&E.
And here is the core of it. PP&E are the physical, tangible things a company uses for more than a year to actually run its business. And that is the answer to our riddle. The jet engine helps an airline fly its planes, and the vineyard, which by the way the rules have a great name for, a bearer plant, it grows grapes year after year. They're both long-term physical things that create value. They are both PP&E.
Now, a company can't just slap anything on its balance sheet. To be officially recognized, it has to pass two big tests. First, it's got to be probable that it's going to help the company make money down the road. And second, you have to be able to reliably measure what it cost. No ballpark figures, no guesswork. It has to be a solid number.
Okay, so we've got something that qualifies as PP&E. Great. The very next question is a big one. What's the price tag? How does a company figure out that first initial number that goes into the accounting records?
And you know what? The rules here are incredibly clear. The absolute bedrock principle is this. Every asset is first recorded at its cost. That number that first shows up on the balance sheet is simply what the company had to pay to get it, whether that was buying it from someone else or building it from the ground up. But here's where it gets really interesting. What cost actually means. It is way more than just the sticker price. The rules say you have to include every cost that is directly tied to getting that asset to where it needs to be and in the condition it needs to be in to work. So think shipping fees, installation, maybe even getting the site ready. But, and this is just as important, look at what's excluded. General business expenses like a big marketing push or training your staff. Those are not part of the asset's cost.
So our brand new asset is on the books at its total cost, and it's doing its job. But its story is far from over, because now, as it's being used year after year, the company has a really big choice to make about how it's going to account for that asset's value over time. And this right here is a major fork in the road. For each class of assets, companies have to pick a path. They can go with the cost model, which is simple, it's conservative, you just stick with the original price tag. Or they can choose the revaluation model, which is way more dynamic. With this one, they periodically update the asset's value to whatever its current market price is. It's a choice between sticking with history or reflecting today's reality.
No matter which model they pick, we have to talk about depreciation. This is one of the most fundamental ideas in all of accounting. And let's be clear, depreciation is not about an asset actually losing value in the real world. Think of it as an accounting tool for spreading out its original cost over the period of time it's helping the business make money. It's all about matching the expense to the benefit it provides.
The process for calculating this is pretty logical, but check this out. Notice how much of it comes down to making an estimate. After you've locked in the cost, management has to make two big educated guesses. First, what will this thing be worth when we're done with it? That's called the residual value. And second, how long are we actually going to use it for? That's its useful life. Those two judgments are the entire foundation for how that asset's cost gets spread out over the years.
You know, every asset, whether it's a massive building or a simple company car, eventually reaches the end of its journey with a company. And that brings us to the final chapter in the life of our asset, what accountants call derecognition.
So, the rule for taking an asset off the books is actually pretty simple. It gets derecognized when one of two things happens. Either the company gets rid of it, sells it, scraps it, whatever, or when it's just not expected to bring in any more money. As soon as its productive life is over, its story on the balance sheet is done.
And of course, there's one last little bit of math to do. Did the company make a profit or a loss on the deal?
To figure that out, you just compare what you got for it from the sale against the value it had left on your books, its carrying amount. And the difference, well, that's your gain or loss from retiring that asset. So, we followed this asset all the way from birth to retirement. And you might be sitting there thinking, okay, but why? Why do we need this incredibly detailed, complex rule book just for a company's physical stuff? Well, this whole standard, all these pages of rules, it really boils down to this one simple, powerful idea right here. The whole point is to give us, the people reading the financial statements, a clear and consistent look into a company's biggest investments. It's all about transparency and making sure we can make fair comparisons between different companies.
And to make sure that transparency is real, companies have to disclose all the important stuff. They have to tell you the choices they made, which model they used, their depreciation methods, the useful lives they estimated. This isn't just a boring data dump, it's basically a roadmap that lets you peek behind the curtain and see exactly how management is handling its major physical investments. So, in the end, while these rules give us a really solid framework, they also shine a spotlight on a fundamental truth about accounting. So many of these huge decisions, like choosing a valuation model or estimating how long an asset will last, they come down to human judgment. Which leaves us with one last thing to think about. When you look at that huge number for property, plant, and equipment on a company's balance sheet, how much of it is cold, hard fact, and how much is a really well-informed estimate?